Welcome to the Canadian Wealth Secrets Podcast with Kyle Pierce and John Orr.
We are recovering high school mathematics teachers and education consultants whose entrepreneurial spirits led us to begin multiple businesses in real estate investing, digital courses, and coaching and consulting after the bell rang at dismissal time.
Fast forward a decade later, where we've grown our portfolios and our time freedom to the point where we can now help entrepreneurs, business owners, and investors to grow their wealth into a legacy that lasts generations through hidden investment and tax secrets your financial advisors won't believe are.
Okay, Kyle. So you said, in the intro here, it's like we're gonna kind of explore the myths. We're gonna take a deep dive into the infinite banking concept. And I'm curious because we've talked many times about this concept. We've talked many times about the tool that utilizes or is needed to utilize this concept. And I'm curious, because we did a lot of research into this concept. I think we first got introduced, hearing the term infinite banking and led you and me down this pathway years ago. And so I'm curious, and I'm sure people who've listened for a while now are kind of like leaning in a little bit and going did something change in you guys? Are you really telling us it's a scam?
Yeah, we definitely tried to utilize a little bit of clickbait, language in the title here. But ultimately, at the end of the day, I do, over time, what I've started to recognize is that, there's I'll say a wide range of what people believe infinite banking really is and what it's good for. Some people believe that infinite banking is permanent whole life insurance, whereas I would argue that infinite banking certainly is, as they would argue, a concept. It's an idea. And in some cases, I would even go as far as to say it's almost like a belief system. And that's where I've, in recent months, I've sort of started to distance myself away from utilizing infinite banking as the term, even though there's a lot of really good things that are going on there. There's also a lot of misconceptions and even, I'll argue, some myths that are, perpetuated by some of what you might read in Nelson Nash's book, Becoming Your Own Banker. Great read, worth a read. As well as what some, as they call them, authorized practitioners might be saying is true, but may not quite be so. And then finally, there's some middle ground there where there's again, this belief system idea where it's like, if you're an infinite banker, then you do this set of things regardless. It's like, it's what you do regardless of whether it actually makes financial sense, because it's based on a belief system that we're going to eventually try to lead ourselves to build what they call a banking system of your own banking system where you could essentially remove bankers from your life forever.
That sounds great though, Kyle. It sounds great that I don't have to rely on, someone else if I need, access to capital, because I think that's what originally, when I read the book, was a huge draw to using the tool, is to go, look, if I, as real estate investors, we would love the opportunity to put two uses to the same dollar. If I could have my policy and utilize the cash value of that policy to go buy my, put the down payment down on my next rental property, and without going to a bank and asking for, that money, or, pulling it from this where I have to always, pay this amount. I don't get to dictate those terms. That was very freeing. And I think that's still one of the benefits of using the tool. That doesn't change the tool. But is that all that the infinite bankers are saying is the philosophy? It's like, we just don't have to want to call so-and-so, and follow their terms on the loan if I need a loan, when I need a loan.
Right. And I would say absolutely. And that's one of the reasons why, again, it's not an infinite banking idea that gives you this freedom. Of course, infinite banking kind of promotes that idea that, hey, this is why we're going to do this. We want to essentially live our lives, be able to be financially free, be able to access capital if and when we need it, all of those things I 100% agree with, right? Like, but that's a participating whole life insurance policy that creates that opportunity. Right. And of course, again, hats off to Nelson Nash, who came up with this idea of like taking what used to be, right? You know, mom and dad or grandma and grandpa's whole life policy was this thing that you paid into for your life. And then eventually it would pay out a death benefit. That was essentially what they were for. And Nelson Nash had the creativity to be able to look at it and go, you know, it doesn't just have to solve the death benefit aspect. It doesn't just have to solve the problem of, hey, what are we going to do after I move on, right? Because I'm earning income, or, you know, because maybe there's some debts that are associated with me and my life that I want to take care of, that you could actually do two things at the same time. You could actually benefit while you're alive, like having a living benefit, and you'll also get this death benefit down the road. So there's, you know, sort of dual purposes that Nelson Nash brought in. And the part that I really liked about it as well, along with you, John, is this idea that you contractually can borrow up to, typically it's 90% with a lot of the Canadian companies, right? But of course, a company could, you know, say it's different in a different contract, but typically 90% of what they call the cash value. That's like the present value of your death benefit. All right. Kind of weird, kind of freaky, but it starts off lower in the early years. You've contributed less, but also the chance of death is much less, like in term policy. And over time, we get closer and closer to the average age of death, right? So that cash value goes up. And basically, Nelson Nash came together and went, you know what? If I have this opportunity to borrow against my own policy, why would I ever go to a bank? And I love the fact that I have that flexibility, but I would argue that an infinite banker, quote unquote, would say that that is like the place that you should be going to borrow money always, regardless of the scenario. Whereas I believe that actually that flexibility is amazing. And I look at it the opposite. I go, where can I get money the cheapest, right? And if a bank is willing to lend me money and it's cheaper than what I can borrow it from the insurance company, I actually like the idea that I can borrow from the bank, even though it's a little more of a hassle. They check my credit score. They can deny you. They might give you terms and conditions like, hey, interest only every month minimum. Whereas the insurance company is like, listen, you don't have to pay anything if you choose not to. Like, that flexibility is great over here.
They could call the loan anytime they want.
They could call the loan anytime they want. Like, a lot of people are like, well, of course I want to then borrow against my own policy. Whereas I look at it the other way and say, if a bank's willing to lend me money, I'm going to take it and I'm going to save my policy for if things don't go well, right? I lose my job.
Or
Exactly. I've got this other access to capital that is there in the case that something were to go wrong with these other loans that I have. So I'm not saying that you borrow over here and you borrow over there, but I'm saying, listen, if you were going to borrow from your policy, why not at least see what a bank would give you? And if it's better terms in terms of the interest rate and they're willing to give it to you, I would rather take it from that bucket, and then I'd leave my super flexible, super accessible bucket over here for a rainy day.
So what I'm hearing you say is, like, instead of kind of trying to be like, I am an infinite banker practitioner where I'm following the letter of the law and always saying I need to have, like, I always should borrow from my own bank. It was, bank on your, Become Your Own Banker, which was the title of the book. Like, instead of just always opting into pulling or borrowing from that source, you're saying, I'm going to assess the risk and the need of my situation right now, and then I will decide who is the best creditor to go with or the best lender to go with based off what I need now and what the source of that money is supposed to be. Now, for example, it's because what you said is, like, I might go to the bank and go, hey, the bank is willing to give me this much money at this rate, and that rate maybe is the going rate. And if you were going to borrow from yourself anyway, you're going to have to pay that back. Anyway, we'll talk about that part of infinite banking in just a moment. But still on the idea of flexibility, is you're saying, I'm going to take on some risk here, because that's really what you're saying. If I go my policy route and borrow from there, because I have the flexibility of repayment, it's almost like, and I'm going to die someday, it's almost like I don't have a ton of risk borrowing from that spot. But if I go over to the bank, I'm willing to give up or I'm willing to add a layer of risk here to go with this creditor or this lender. I'm going to follow their terms because I want to take this money and do this with it. And you're just trying to go, hey, why wouldn't I take the lower payment if I'm okay with the risk?
Right.
Or I think you're also saying that, but you're also saying, why wouldn't I want more money? Like, why wouldn't I have access to more money and go that route? Because if I go with my policy only and I max that out, do I stop? Like, is that it? Like, I have no more access to capital because I'm not willing to go to the bank now?
Right.
Like, you're saying, hey, I'm going to leave that over there as my, like, next in line money because it's always going to be there for me. Over here, I'll take what I can get over here until that's maxed out.
Yep.
Then I'm going to switch. So
Totally.
You're trying to access capital.
Yeah. And I bet you any real estate investors are nodding their head right now going like, that totally makes sense. Because real estate investors know what this is like, right? Where they go, I'm going to try to borrow funds because who knows if it's going to be there tomorrow. You know, when banks are really, really welcoming to lend you money is when you don't need it, right? When you need it, when you have an emergency, when you lose a job, when you're an entrepreneur and your business isn't doing well, you go to the bank, you're like, hey, can I borrow some money? And they're like, well, I'm looking at your financial situation and we might not get paid back. So no. So I'm looking at it going, why not save this other bucket over here for an opportunity that might come after I've already borrowed? Because if I borrow out of this bucket over here, and maybe it's for an opportunity, I buy property or, and again, this is the other piece about infinite banking. Like I'm not borrowing capital on my policy for like small things. Like I'm not borrowing it for like, a $2,000 purchase, like that's not worth it to me. It's like maybe for a car, if the rate makes sense, maybe, but if the car dealer's giving you a much better rate and much better terms, again, I'm going to go to the car dealer, right? I'm not going to go to my policy because I want that flexibility. I want that bucket there, not only for emergencies, but also for an opportunity that might come up that I need to act on fast. So we've talked about it in earlier episodes, oftentimes the best deals in real estate, but also other aspects of life usually happen fast, right? So when a property comes up and somebody's like really needs, to get out and they're like, hey, I got to move this thing. We got to close in like 8 days or 4 days or whatever it is. Imagine being able to go, got this other bucket. I don't need to apply for it. I don't need to, do any of that stuff. I have access to it now that I can now utilize that bucket instead of me having already been utilizing it and doing all these things over here when the bank may have been willing to lend me money. Again, home equity line of credit's a perfect example. It's sitting there. It's easily accessible. And right now, I would argue, I'm going to take from my policy over a home equity line because my policies, the actual interest that they're charging at the insurance company is actually cheaper than what my home equity line of credit is. So that makes perfect sense in today's environment. However, 2 years ago, when we were at like all-time or, almost all-time lows in terms of the overnight rate, it was way better to borrow on a home equity line of credit than it was to borrow against your policy. Right. So again, it's just making a rational choice about where you take money from based on your circumstance is more important than, say, the belief system of whether I am or I am not an infinite banker or a bank on yourselfer.
Yeah, and you're just saying I'm keeping my doors open and I'm not closing any doors, and I think that makes a lot of sense. Okay, now let's also talk about I think something infinite banking practitioners will hang their hats on, which is kind of like a story that I think if you've read Nelson Nash's book, you remember this story because it's talked about a lot of times as like the reason that you open up your dividend paying whole life policy. So the reason is like this story about like don't steal the peas.
The grocery store problem.
Let's talk about the don't steal the peas because it makes a lot of sense to not steal the peas. But Kyle, fill everybody in. Like give a short synopsis of this don't steal the peas, lesson
Yes.
that Nelson Nash talks about in the book.
For sure. And if you haven't read the book, again, I'm not saying not to read this book. I think you should. I really do. I'm just saying that what you take from it, just make sure that you're being analytical about each thing. And I will argue that the grocery store example is a great example. And there's a lot of really good ideas there. But there's some parts that, again, that I disagree with slightly. And I feel that are a little bit more nuanced. So this idea is an analogy that you own a grocery store. And they're talking about the idea of a few different ideas here. First of all, it's like when you open a grocery store, you're going to have to capitalize the grocery store. You're going to have to buy the cans of peas is the idea, right? Buy the grocery store items. There's cost to buy, buying the building.
You're starting a business.
You're starting a brand new business. And the analogy is the same is true with a participating whole life policy in order to start the infinite banking process, or what we just call is getting a policy and being able to be super flexible with it, right?
It explains that why the cash value isn't 100% of what you put in.
Totally. So it's like, you buy a grocery store or you buy real estate property is another great example. It's like, hey, if you buy a property and then you sell it 3 weeks later, you're actually like going to lose money, right? There's closing costs, there's, all these things, land transfer tax, all those things, unless you actually added something of benefit to the property to raise its value. So here it's like, okay, there's that. Perfect. That makes a ton of sense. So you're capitalizing this policy. So in the first couple of years, you're not like able to like fully utilize the premiums that you're putting into this policy in the first couple of years. Totally get that part. That makes a ton of sense. But then they start talking about a couple different things. So they do talk about the idea of don't steal the peas, meaning don't like borrow against your policy and never pay it back. So they're kind of talking about this idea of like, you can't just in your grocery store, every time that we come into the grocery store and we were walking down the aisles, that you're just grabbing cans of peas off the shelf for yourself as the owner. You just buy them, you bring them home without buying them, you steal them. They're talking about taking a policy loan and not paying it back or not paying the interest back in the early years. Makes a ton of sense. Like we don't want to put the money in and immediately borrow it and never pay it back. That would not work. It's not going to work in the long term. So I love that analogy. I love that part of it. But the part that I sort of, a lot of people talk about this and they describe this scenario as like also the idea that if you owned a grocery store, that you would buy the peas from your own store and you wouldn't from a different store, right? This idea. And that's the idea of where you would borrow money from. And this comes down to the thought that, hey, if I'm going to borrow money from somewhere, wouldn't it make sense? And I've heard different practitioners say this, and I actually disagree with it. They say that if you're going to borrow money, even if it's maybe higher interest to borrow from your policy, remember, you own the policy. That means that you are an owner of the mutual insurance company. You are part owner, which means that interest goes back to you. So you are actually borrowing money. Maybe it's at 6% and maybe you could have got 4% somewhere else. It's like, it's okay because you paid 6%, but it goes back to you. And that portion. Yeah, exactly. And I mean, that might make sense if I was buying peas. I would probably buy the peas from my own grocery store. But let's be honest and say, if you were the store owner, you would probably buy the peas at wholesale price and you would take them out the back door and you would eat them and bring them home for your family because you own the business. Here, I'm going to borrow money. I'm going to pay more in interest. The interest goes back to the insurance company. But the reality is the dividends they pay on the participating policy that you have are so minimally affected by the money borrowed against policies that is such a non-issue and ultimately a silly argument altogether.
Wait, so because that's a fundamental. I think that was a fundamental idea of the don't steal the peas out the back door, which is I want to use the money from my policy because I'm going to pay interest back to that policy. It's going to go in the pot of everyone else who's doing that, and that adds to the bottom line of the company that I'm, as a shareholder of I get distributed, that money goes back to my dividends, which creates more money. Like, it makes complete sense. And what you're saying is that it's not a lot. Like, is it kind of like, it's kind of like the don't steal the peas. Like, if I think about my can of peas, it's like my can of peas is only like a couple cents I get all of a sudden back. Is it like, but what I tried to wrap my head around, but is if everyone did that, right? Like, if I did that, if I made the choice to be like, you know what, I'll go borrow the money from the bank instead, because it's only so small. It's like, you said it was minimal. It's like, okay, well, the interest I paid, let's say it's a couple $100 that year, a couple $1,000 that year. It goes in the pot. It's distributed across everyone, other, policy holder in a dividend. That's not going to be a lot. Okay, well, what happens, Kyle, if everybody did that? Like, if everyone did that, I feel like that's the reason we do it. It's like, if we do it communally, then that pot should be big.
Right.
And then we all get distributed that way. So if everyone did it, like, does this fall apart?
Yeah.
Like, I think that's where they hang their hat on.
Totally.
Is that we are building a business together with all the other policyholders.
Totally. And ultimately, at the end of the day, it's completely inaccurate. And it's essentially, I'm going to stack it up to ignorance, and not that it's intentional misleading. That's what I'm going to say, because I actually think the vast majority of people out there, I was on a call recently, somebody who required a permanent whole life policy for their corporate wealth management plan. This person sold whole life policies for 10 years and didn't understand how they worked. And he actually didn't understand the benefits of why we would do it inside of a corporation. There are so many misconceptions, and there is so little true understanding of how they work. Up on the screen for those on YouTube with us right now, I'm showing Sun Life, Canada's oldest insurer. Their participating fund, when you look at the breakdown of it, right? Look at the breakdown. Real estate, 15%. Equities, almost 20%. Private fixed income.
This is in the dividend paying back?
This is in the dividend paying
policy
pool. Now, corporate bonds, 14%. Government bonds, 23.5%. They run it like a pension fund would, right? Remember we did the episode on recreating your pension?
Yes.
Well, I mean, the reason why it can be done so well is because a participating whole life policy actually runs a lot like a pension fund. So the Ontario Teachers Pension Fund doesn't give teachers all the money they earn on the money that goes into the pool. They give you some of it. They earn way more each year than you get. So over here, you'll notice there's a 1.2% sliver. That is cash and short-term funds. And that is where the money for dividends is coming from. And most companies, most insurers actually do not support the idea of infinite banking in the, we'll call it, traditional sense. They do support it in what we advocate for, right? Which is borrowing when it makes sense for opportunities, that sort of thing, but not like to fund small parts of your life or to completely remove banks out of the process, because they're not a bank. They don't actually want you to constantly be borrowing and paying it back and pouring and paying back like a home equity line of credit. So when I look here and go, my interest, I paid more interest. So first of all, I paid, say, call it 2% more. In that case, the 6%, 4% example, total example, completely fictitious. But that extra 2% is like such a small chunk of this pie. And then it gets divided up, of course, amongst all of the different policies. But here's the crazy part, is that the dividend that they pay out, right? Last year, Sun Life was somewhere around 6% dividend paid out to the policy owners. Sun Life made in the low teens on the actual participating fund. So the idea that like all the earnings is shared fairly across, all of the policies is not true. It's just like Apple doesn't give you all of their profits as a dividend, as a shareholder. They decide what the dividend is. And of course, much like a stock, they're not going to have it significantly drop in a year or significantly bump in a year. They're going to try to keep it as consistent as possible, showing slow growth where possible. And it's really heavily based on the dividend pool. So that idea that I'm going to pay more in interest. So this is Sun Life. I'll show another one. Here's Equitable Life. You look at their breakdown. Their breakdown is very similar. They have 2% allocated to other. Right? The rest is everything else. So it's super diversified, which is great. Equitable Life made, I think they said something like 12% on the participating fund pool. And last year in 2023, I think it was 6.1% that they paid out as a dividend to policyholders. Now, a lot of people would be like, well, where's the rest of the money? Well, ask your pension company the same thing. Well, they have the massive pool. They need to make sure they can pay out death benefits. They need to make sure they pay for advertising. They need to make sure they have all their expenses covered. And they need to make sure that they're paying commissions to the people that are helping you to understand policies and actually put them into place. So your policy itself actually has, I would argue, little to no impact as to where someone who owns a policy borrows the funds from. And I would argue that most companies would say, hey, listen, policyholders, if we could choose whether you borrowed against your policy or whether you didn't, we'd prefer you didn't, because then we could go make more money elsewhere in this pool over here where we made 12% instead of 6% in this random scenario I gave you.
So I feel like that debunks the whole make sure that you contribute back to the business because you're adding to the bottom line of the business. Now, I guess like it's such a fraction, like you said, it's a minimal amount, and in the reports there show that it is a minimal amount of that sliver. Like it didn't say that's where the policy repayments are coming from. It was just short-term loans in other. So,
right. You know what would be better, John, with that extra 2% in our scenario? It would be better to buy more paid up additions on your policies. So the insurance company would say, listen, you want to know how you can maximize the benefit of this business? Pay the maximum amount on your policy that we've structured with a base premium that's much lower and a max premium that's up here, rather than paying less in a year because you actually chose to pay higher interest on your policy loan than you did over here. Why not just maximize how much money you'll put into our pool over here in our participating fund? Because we can make more money off of that than we can off of your interest that you're paying us. So, that would be the best way to grow the business, is to contribute as much premium for as long as you can. That's what the insurance company is saying, right? And you're going to get a benefit from it as well, instead of paying higher interest for no reason.
Yeah.
John, we went on a deep dive, and I wanted to just take a moment to just talk about two other myths. So first of all, well, I guess the first myth is this idea that a policy loan is calculated with simple interest and therefore, once again, is way better than borrowing from the bank, even at a higher rate. I want to clarify that, because really what the real difference is that a bank will typically charge on a home equity line, for example. Every loan's different, right? So you'd have to look, but on a home equity line, typically they're compounding the interest every month, right? Which means you're paying interest on interest if you don't pay it all back, right? So that's important to note. On a credit card, it's daily, right? So that's really bad, because now you're compounding. The longer it goes, we're going to compound on top of each other. But with a policy loan, it actually isn't simple interest, right? As former math teachers, we know that at the end of the year, they apply the interest to your loan. And how you can keep it to act kind of like simple interest is by paying off all that interest by the last day of the year since you borrowed the money. That would allow it to kind of act like simple interest. Right. But the reality is, if you chose not to pay it back, in the next year, you're now going to pay interest on the interest. That is the definition of compounding. Okay, that is what compounding is. So it compounds annually instead of semi-annually, monthly, daily. Right. So it's still better. But again, that's a myth and a misconception that I hear a lot of authorized practitioners say that actually is inaccurate. And then finally, the last thing that I think is really important is just really thinking about, like, at what point in your journey would, I'm going to call it, participating whole life insurance make sense for you? Not the entire belief system of infinite banking, but like, when does this realistically make sense for you? And I'm going to argue that as an emergency fund, we have an episode on that. It's a great move. If you were going to save money for an emergency fund, starting a small policy makes sense regardless of where you are in the journey, right? If you're going to do an emergency fund, you're going to contribute X number of dollars. That's a great move, because you're going to earn interest and you're going to grow a policy. And that's a great, great start. But that's not going to really serve a purpose of infinite banking right out of the gate. So the question then becomes is like, when does this make sense? And I would argue that you should at least be investing in something. If it's real estate, if it's tax-free savings accounts and RSPs, those tax-free buckets are really helpful for you. So if you have $0 of investable assets so far, I would argue that trying to go down the quote unquote infinite banking route might not be the right move now. I'm not saying it's not a great move later. I just think that it's not the right move now. I would get your investments going. Some people say it's like, hey, listen, with participating whole life, you can get rid of Wall Street. Or here in Canada, you can get rid of Bay Street. You don't have to invest in the markets. And I would argue that that's a really conservative approach. The answer is yes, you could, but that is a really, really conservative approach, which means you are not going to see a lot of growth. You'll probably just pace with inflation. And I would think that if you're listening to this show, that isn't you. Like, you're not that conservative. Yes, I would use a participating whole life policy instead of bonds, instead of that fixed income part of my portfolio, whether it's 10% or 30%, or for some of you, 50% of your portfolio. I think a participating whole life policy makes a ton of sense because you get all of what you were getting out of that bond thing without the risk when a black swan event happens, because bonds and stocks only correlate when the market tanks. When it tanks, everybody dies, right? That's not a good thing. So I would say that's a great move there. So ultimately, I'm hoping when people listen to this episode and they think about it, we're not bashing participating whole life insurance. We are not even bashing most of the infinite banking concept, but we are just trying to clarify that we don't deem ourselves as infinite bankers, because fundamentally, there are a lot of things that are going on there that we simply just do not believe and do not make logical sense. Although a lot of the, I'll say, call it 75% of the idea is a great idea, and it's worth exploring. It's worth reading the book, and it's worth digging into, whether it's through someone else or hopping on a call with us so we can take you through the rabbit hole and really help you understand, how does this work? And is it a good time for you to put this into practice? If you're a business owner who's successful, meaning you have a lot of retained earnings, that sort of thing, then I would say that you should have put one in place already. And for those who do not have a corporate structure, there's a specific time and place where I think putting one into place makes sense. And there's other times where holding off probably makes more sense, and just going into learning mode in the meantime might be your best bet.
Yeah, and I think today's secret sauce, the Wealth secret sauce today is one of our strengths in particular, is continually looking at your financial decisions with what you said, logic, with analytics, thinking about what makes the most sense for where you are now, and not just following dogma, not just following this is what I'm supposed to do because I'm, identify as this type of person. Continually think, what is the most economical, or what is the most logical, or what is the most, analytical decision I can make, and how do I get that information? That's what we try to do here on this podcast. That's how we make our decisions. So the secret sauce today isn't to just follow, the orthodox view of one philosophy. It's think, with appropriate reasoning before you make your decisions.
I love that. That's a great Canadian wealth secret there. Friends, my big one for you is, continuing to learn and just being aware of what it is that you need for your journey. Because the reality is that, you're not an infinite banker. You are or you aren't. That's not really what it comes down to. It's, what are your specific needs? Hey, listen, if you're passionate about hating the bank and you truly want to get rid of them, rock and roll. It's not for me. It's not for me. I'm going to use banks until, and I'm going to keep all of my doors open to try to ensure that I can better my situation all the way through the remainder of my life. Even if my intent is to have so many permanent whole life policies, or at least the cash value and the death benefits, so that I just feel like I have this solid capital preservation foundation. We talked about it on a previous episode where it's like building that cement pad. I want it to be as thick as possible. That's why I'm doing it. It doesn't have to be why you're doing it. I know, John, you're doing it for a similar reason. I am a conservative person, but I have risk on assets. I'm in real estate. I do all of those things. And I just want to make sure that I have access to capital when an opportunity comes up, when an emergency arrives, or if the bank, for whatever reason, at whatever time in the future, says I can't borrow money, not because I don't need the bank anymore, but rather because I need to access capital from somewhere. And guess what? I have it. It's like permanent policies are like my mattress I can shove the cash under, except the value doesn't go down, it goes up tax-free, and that death benefit's going to pay out tax-free. And for our corporate business owners, you have a massive advantage that you get to buy the same permanent policy that T4 employees are buying, and they're spending it, 60 cent dollars. They've already lost 40% in taxes. They're buying it for 60 cent dollars, and you're in your corporation able to buy the same policy for 88 cent dollars, and it will pay out through your capital dividend account, the death benefit tax-free, plus all kinds of other, advanced strategies you can put into place. To me, the actual tool, participating whole life insurance, is a massive benefit for many people, but not all people and not at all times of life. So hop on a call with us to learn whether it makes sense for you over at CanadianWealthSecrets.com/discovery. Again, it's CanadianWealthSecrets.com/discovery. And our goal is that you walk away knowing more about any tool that we're working with you on, not to try to convince you of a tool being right for you. It's about you learning and deciding when is a tool appropriate for me to reach my wealth goals.
All right, Canadian Wealth Secret Seekers. See you next time.
Just a reminder, my friends, the content in this podcast is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.
John Orr is a mortgage agent with Bricks Mortgage, license number M23006803. Cal Pierce is a licensed life and accident and sickness insurance agent and corporate wealth management advisor with PanCorp team, which includes corporate advisors and Pan Financial.